Now, as I mentioned, the large companies, the first responders were very quick. They were usually the big companies, simply because it was a little less painful for them to do it. If you're a BHP and you've got 23 copper mines, it's a lot easier for you to basically shut down 3 of them or cut back production 10% at 10 of them or do something like that, which a lot of them did relatively quickly. It's been a lot tougher on the little guys, the guys that have one mine, of course. If they shut the mine down, they basically have nothing to do. It's been a much harder decision for them, but a lot of them have done that as well, especially on the zinc side. One thing that's different about this cycle, I got asked about this after the lunch thing, and I said I'd go into this a little bit here, and this is a fairly important point. This is a fairly long base metal cycle. I mean, it's a secular cycle. The prices were fairly good for most metals for a long time before late 2008. That gave a lot of miners a chance to really clean up their balance sheets. Relatively speaking, relative to previous cycles, most of the large base metal miners are in actually pretty good shape in terms of their balance sheets. That's important because if you go back to some of the last cycles, I think I pulled the zinc chart out of here, but if you go back to the end of the last cycle, for instance, zinc went all the way down to 34 cents. It stayed under 50 for about 3 years, which was below anybody's cash costs. The reason why it stayed low that long was there were 2 large producers, the main one being in Australia, that had basically gone on an acquisition binge in the late 90s. They bought up about 8 mining companies, smushed them all together into one. They did almost all of that with debt. And when the zinc price dropped, you basically had these banking certificates in Australia that had, you know, 200 million on that mine, 300 million on that mine, 500 million on that mine. And essentially it was the banks keeping the mines open, not the mining companies. The bankers were saying, you are not shutting that mine down, because as soon as you do that, I have to write this loan off. I do not want to write this loan off. So we'll give you little dribs and drabs of money just enough to keep you alive. But you're not allowed to turn out the lights until we say you can, because we're not writing this freaking loan off. And that gave zinc a much bigger, I mean, there was a huge inventory build in zinc at the start of this decade. The reason why zinc was the last metal to react was because of that inventory build, and it was largely because of the credit conditions that mining companies had last cycle. Most of them are actually in much better shape this time around. They're not, there's a couple of them, but there's very few that are actually beholden to banks, if you will, the way they were last time. Copper was the last one, and arguably it didn't really get down to cash cost level. I think the average cash cost right now is probably about $1.10. It's probably seen the smallest cutbacks because of that. There were simply fewer guys that had to close. The supply cut right now is probably 2 to 4%. I think there'll be a couple more. Nickel is the most concentrated base metal, and they've had by far the biggest cuts. I just said over 10%. It's actually about 15 right now. You certainly can't see it in the nickel market yet, but they've cut a lot. And that's partially because there's basically 3 producers that account for about 60% of the metal market. I suspect what happened with nickel, I don't think anybody knows, is I think nickel's one of those ones where there might have been more supply, more buildup of inventory and hedge funds and stuff like that that's only started coming out recently. Because I get the sense that the big guys, which in this case is essentially BHP and Strata, they're kind of scratching their heads going, where the hell is this stuff coming from? Because we shut so many mines down. Strata is basically shutting down Sudbury for the entire summer, which is the world's biggest nickel mining complex. So nickel's probably one to keep an eye on. It hasn't done anything yet, but I keep an eye on it. And the simplest way to do that is if you go to the UK website, lme.uk.org, I think it is. Just look for London Metal Exchange. You can actually find this. You can find this on Kitco Metals as well. Keep an eye on the inventories, because nickel's inventories are relatively high this time. Coppers are low, zincs are low compared to this part of the cycle, but nickels aren't. Nickel's one of those ones that I think might surprise people, but you've got to see the inventory come off first. So that's basically what we're waiting for before we get too excited about it. Zinc's got the worst record in terms of having losing producers. It's closest to its cash cost. 6 to 7% come offline. I know of 2 or 3 fairly big ones that are teetering on the brink that may or may not be able to stay open unless prices move up at least another 20–30%. Zinc we like later in the cycle, and the reason for that is because there's a couple of long life producers like Brunswick, there's 2 or 3 others. They start going offline next year, so there's going to be a substantial drop in supply. And what's happened so far is really supply side doing the rebalancing. The big issue obviously, and this is where the rubber meets the road, if you will, is what is the demand going to be? I don't think anybody knows. I don't think we're out of the panic phase yet. I mean, I don't have a clue what's the base demand rate for copper, for zinc, for nickel this year, next year, the year after. I think we're only starting to come out of the panic mode. I mean, I've talked to producers in Asia that told me from about 15th of September to the 15th of March, which was basically after the Lunar New Year, was well over in China. There was nothing, nobody, not an order, nobody was at the door, phone didn't ring. All of a sudden the orders started flowing in when the Lunar New Year was over in February. We don't know what the actual base demand is going to be. We obviously think it's going to be better than some people, or we wouldn't be talking about this stuff. But we're not going to know for a while. Now, when Dave and I started talking about a secular commodity market 9 years ago, the reason can be best summarized by this chart. It's a bit complicated, but I'll walk you through it because it's important, and we harp on this again and again and again because we get tired of people. In the last year and a half, we've had so many people come up to us and go, like, you guys just don't understand this. It's not really a secular bull market. You don't know what's happening to demand, blah, 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 blah. Okay, it's not about demand side, people. It's about supply side. This is an important thing you got to understand. This is about supply side. You don't need much demand to mess up the market because the supply side's got a real issue because basically there was no investment in this sector for 30 years. This chart is one that Xstrata put together, and it's a great chart because what it shows you is every year they went back and pulled together the industry reports, the analyst reports, and they basically added up the top 50 proven and probable mine developments. In other words, this was what the mining industry agreed would be coming on stream in the next 3 or 4 years. So if you're sitting at 2001, they add up all these different proven and probable mine scenarios. This is what the market thought would come by 2007. Basically, in 6 years, it would be an added 6 or 7,000 tons of 6 or 7 million tons of copper come on stream. And then they went to 2002, and they went through the same exercise. And the reason why this is a nested curve that isn't moving up much is this curve here is what actually came on stream during those years. So if you bring this, if you go to 2001, by 2007, by 2006, the analysts figured there'd be another 7 million tons. You bring this line down to here, what do you get? There was actually about 1,300 tons that actually came on stream. You move this forward, this one only goes to the end of 2006, but basically the story doesn't change at all. And the important thing to look at here is that 2007, 6 years later, of the 7.1 million tons that was supposed to be online, 1.3 was online. This is the way the mining business works, folks. It's very hard. You know, people look at stuff like 3 or 4% increase in demand per year in copper. How hard can that be? I mean, hell, you can throw up a semiconductor plant in a week in Malaysia and you're done. It's really hard. Trust me, I come out of the mining business. It's hard. It's very hard to do because you have to remember that all of these things that are in production now, they all have limited lives. So in order to add 3% a year, what you really have to do is generate about an extra 2 or 3 million tons of new production every year to account for what's coming on stream at the same time. So this is a chart. I'll probably throw this up on our website, HRA Advisor. I'll just throw this whole thing up here. But that's a good chart to kind of have in the back of your mind because people tend to get way, way too optimistic about how quickly supply is going to come on stream. And believe me, what's happened in the last 9 months has just made things much, much worse. Because right now, I could probably sit down and name 20 companies to you that have feasibility studies in place, large deposits, okay economics, maybe not the best, greatest in the world, but you know they look doable, and the company's market value is about 1 or 2% of the capex that they would need to put those mines in production. Do you think those are going to get built anytime soon? No. Not so much.